Welcome to video number 2 on how to conduct a business checkup. In this video, we're going to cover pages 13 through 30 in the Business Checkup Workbook, if you'd like to follow along there. Let me introduce you to Bradley. Bradley is a business owner who's now able to enjoy the fruits of his labor and enjoy local drinks on a tropical beach whenever he wants. But it wasn't always that way. When we first met Bradley a few years ago, he was a much different person. Overworked, underpaid, constantly worried about making payroll in the future. It seemed Bradley never had enough time, energy, or money to make his business truly successful. He was competing in an industry with many small operators, and Bradley's company was just one of many struggling to survive. Due to the changing environment, Bradley felt like opportunity was always just right there at the door, but he could never grab hold of it. It was always slipping away. As a result, he felt like he was always chasing the next deal, and he never actually caught it. Like most businesses, his company was characterized by high risk, and with cash very tight, every decision felt like a life or death gamble. Even the simplest decisions stressed him out because of his company's uncertain future. In fact, it all became painfully obvious one particular day. His managers were all complaining that they couldn't do their jobs without more resources. They were nagging at him. At the same time, his wife was frustrated because they hadn't had a vacation in a very long time. Well, it all came down to this. It came down to cash. More precisely, not enough cash. Bradley knew that he needed cash for 3 purposes. He needed to pay himself more. He needed to invest in marketing and sales. And he needed cash to reinvest in his business in order to get it to the size and value that he wanted. How many of you know what sweat equity is? Well, we've all heard the term. Well, our definition of sweat equity is the feeling that you have when you wake up at 3 o'clock in the morning in a cold sweat, wondering how you're going to pay tomorrow's bills. As a business owner, you should be compensated for your sweat equity. Well, Bradley felt that too. He just didn't know how to get there. And he faced the same fundamental question that many business owners face today. How do I get where I need to go, and where do I start from where I am? Where should I begin? So, how do you start? Cash flow engineering rule number 1, start with the end in mind. You start by getting clearly in mind where you want your business to go, where you want it to be in 2 years, 5 years, 10 years. Then, once you clearly have in mind what your destination is, then you bridge the gap. In other words, when you know where you want to go and you understand the challenges standing in your way, then you just methodically, step by step, begin building the bridge over that gap. Which brings us to rule number 2, and you'll see why in a moment. It's don't reinvent the wheel. A lot of people who run businesses believe that their business is different from any other, and that they have to reinvent every aspect of their business from scratch. But honestly, business owners aren't paid to reinvent the wheel. It's a waste of time, energy, and money. You should never start with a blank piece of paper. Instead, use a recipe, a system that allows you to fill in the blanks and to get going fast. There are 4 major reasons today that businesses need your services as a certified cash flow engineer. Number 1, to drive cash flow and revenues fast. That is to make more money. Number 2, they need help growing their business to the next level. In other words, to build a sustainable business, one that lasts for the long term. Number 3, they need help replacing themselves so they can spend more time with their family instead of living at work 24/7, and so that they can ensure that their business doesn't implode if they aren't there every minute of the day. 4th, business owners need a clear exit plan and help executing it so that they can retire or start another business or just enjoy the fruits of business ownership. Likewise, there are 10 top reasons that have been cited by Forbes magazine that business owners hire an advisor. Number 1, to obtain specific expertise. In other words, they want you to show them or to help them do something that they don't know how to do. Number 2, to take advantage of skills that they don't have in-house or to supplement a company's internal staff at specific times and for specific purposes. Number 3, to identify problems and to provide solutions that they're just too close to the forest to see. Number 4, they hire advisors to come in for a creative perspective or to validate the ideas that they may have already come up with, because they're not in a position that when they come up with an idea, that's reinventing the wheel. They need someone to validate and verify that what they want to do has worked in the past and will work for them. Number 5, they hire an advisor to act as a catalyst for change, to come in and analyze what they're doing, to diagnose where the problem is, to uncover issues that exist in the business, and then direct them on how to solve these so that they can move forward and change. Number 6, they hire advisors to teach them and their staff new, better ways of doing things, to teach best practices. Number 7, they hire advisors to bring new life to an organization, to just energize people. Not that you need to be a motivational coach, but when you're bringing in best practices and you're giving advice and you're showing people how to polish their processes, that energizes people. That gets people enthused. Number 8, to assist with a business launch. When new businesses get started, the best thing a business owner can do is to get help and direction. Number 9, to create and implement methodologies and systems that enhance efficiency in organization. Help us do what we're doing better and more efficiently, they say. And finally, number 10 is to provide a shortcut to know-how, knowledge, and information. That's how they see you. That's what you actually bring to the table. More knowledge and information that it might take them years to assemble and to put together on their own. So those are 10 reasons why you are in high demand as a cash flow engineer. What's the delta? Well, the key to everything we do is to ask a lot of questions to determine the difference between where a company is now and where they want to be. So we're looking at what the trends are, and we're looking at how to develop strategies to get them there. So the delta is right there. What's the point where change begins to take place in a positive way? Let's back up and ask one central question. What's the number one objective of a business owner? And this is found on page 16 of your manual. Many business owners would say, well, it's to manage the business. It's to move the business forward. Well, if we want to be literal, the number one objective of a business owner is to drive consistent, predictable, and sustainable cash flow into the business. Without cash flow, you don't have a business. You need money to grow your business. You need money to invest in marketing and sales, to pay yourself and your employees more, and to make the business grow. So the number one objective of a business owner is to generate cash flow. And there are 3 areas of business that require investment: marketing and sales, operations and organization, and financial management. These 3 areas are all related, and it's imperative that all 3 are fully integrated and work together to have a fully operational business. In other words, focus on the whole business, not just the individual parts. To illustrate this, think of a car's engine. For the engine in your car to work properly, all the components of that engine must work in unison. If the fuel pump isn't working up to spec, the whole engine suffers. Nothing works properly. Likewise, when you're looking at your business, you need all aspects of the business to be working effectively. When marketing and sales is working properly, you have a steady flow of new projects, new leads, new people to work with. Your business is being infused with more people. It's growing. The leads you get are the right type of customer. You close at an acceptable rate. Products are priced correctly, not by your competitors, but so that you can be profitable and the business can grow. Salespeople are making money. The business is making money. When operations are working, costs are estimated properly. Jobs are completed on time. Things are running smoothly. Jobs are completed within budget. And they are profitable. They meet your profit objective. Customers are happy. Service is good, so customers are coming back. They're buying again. They're reinvesting in your company and in your services. Direct and indirect costs are being controlled. So when operations works, everything is running smoothly. And this builds better morale within your company too. And when your financial aspect of your business is running correctly, you always know how much money you have in the bank. You're collecting money before work is performed instead of afterwards and trying to collect to pay debt. You never worry about making payroll. You know how much is going out, how much is coming in every week without having to guess. You make profit on every job, and you don't have any surprises that come up that bring you and your profit down. And finally, your banker loves to see you when you come in. If you got a request for him, he's eager to hear it. So those are the three aspects of business. So how do we do that? How do we accomplish a business where all three parts are working in unison and humming along in an efficient way? In reality, how do we turn a business into a cash cow? Well, what is a cash cow? We look at a business and we define it as a cash cow when the business continues not only to make a profit, but generates consistent, predictable cash flow day after day, week after week, month after month. A cash cow is a business that only requires a few minutes per day to manage, instead of having to have the owner present every minute that the business is open. It gives the owner financial freedom. It gives them time and energy to enjoy the benefits of ownership, not keep you chained as its slave. And really, isn't that what every one of us got into business to achieve? The objective of cash flow engineering as a concept, as a discipline, is that in cash flow engineering, you view every dollar spent as an investment. If you paid out $1 and you knew absolutely that you'd get a return of $1.25, wouldn't you throw every dollar that you had into that investment? You wouldn't think twice. It wouldn't be painful. But you know you're making a profit. Well, the keys are being able to predict that return and have the cash flow to invest and generate even more cash. There's a problem here. We talked about problem number one as being the number one problem all business owners face is lack of cash. Problem number two is arithmophobia. And yes, that is an actual condition. It's the fear of numbers. We often fear what we don't know or understand, and that's certainly true of the numbers that flow through a business. In reality, business owners simply don't know which numbers to watch. They don't know when to watch them or how to respond to them, how to interpret them, and what to do if they don't like the numbers that they see. It can really be terrifying. And that's where you, the certified cash flow engineer, comes in. Measuring the factors that lead to success is another critical factor. And really, this is why people fear the numbers, is they don't know how to measure them. They don't know what they mean. Look at the cash you had on hand last month. What about 6 months ago? And what about 12 months ago? If it was about the same, then there's probably no reason to think that anything will change tomorrow unless you do something different starting today. Measuring leads to obvious insights into what works and what doesn't, so decisions become much easier to make. Measuring gives you numbers you can trust, and that trust turns into confidence about your decisions. Confident decisions lead to rapid profit increases. Confidence also leads to peace of mind. It makes operating a business so much easier with less stress, less pressure, and more clarity in results. For instance, we've seen increases in performance just by showing business owners how to measure the numbers in their business. If we start measuring our conversion rate from incoming leads to paying customers, and measuring it every week, we found that that number tends to increase by 10% almost instantly without having to do anything else in your business, just because you're focused on it and what you're looking at you want to improve. This increase translates into cash in the bank. So measuring is a critical part of cash flow engineering. As business advisors, as certified cash flow engineers, we're looked to as the experts that teach individuals to see through the cascade of numbers and distill that information into something that is useful and actionable. During the rest of this course, we'll introduce you to the 7 key numbers that drive cash flow through a business and increase the sales that will secure a business future. During this course, we're going to dive deep into the 7 key numbers that drive cash through a business and then increase the sales and growth that will ensure a business future. Our goal is to take away the fear of numbers and to make numbers our friend. And that's your goal as a certified cash flow engineer. So, what we've covered so far is, number 1, you must understand the business owner's mindset. That when they look at their numbers, they don't see things the way we do. They fear them. They don't understand them, and so they have arithmophobia. Second, how are you going to make a difference in their cash flow? And you're going to make a difference by looking at the numbers, by calling each one out, and by beginning to measure and monitoring what their key indices are in their business. And finally, how are you going to make a difference in their attitudes toward their numbers? How to make their numbers their friends by showing them how they are not dangerous if they are managed and controlled, and giving them the mechanism to better control their numbers, to tame them so that they actually look at them and view them in a positive way. I want to introduce you to another concept, what we call the 786 principles. You'll see us refer to this as the 786 business growth system or the 786 dashboard. These 3 elements are the foundation of cash flow engineering. They are the 7 key numbers that drive all revenue and allow you to control cash flow in your business. Number 2, the 8 Ps, functions in every business that can actually be the levers that you use to make adjustments to the 7 key numbers and that give them their power and allow you to optimize the processes within the business. And the 6 success factors, general principles that should act as your guiding lights to continual improvement and fulfillment. Understanding your 7 key numbers, your 8 Ps, and the 6 success factors will help you to virtually guarantee your success in dealing with your clients and make that same guarantee to them. As they understand and get control of these 3 individual elements, their businesses will prosper and thrive and grow. In reality, the skills that got a business owner into business to begin with may not be the skills that they truly need to run their business. See, running a business is a learned skill. To run a business, the owner needs to be able to lead, manage, and execute. And while most entrepreneurs, owners, and top-level managers are good at 1 or 2 of these, rarely is one individual good at all 3. That's where they need help, and that's where they're going to look to you as the certified cash flow engineer for guidance. Once again, never start with a blank piece of paper. Don't reinvent the wheel. Instead, use a proven system that allows you to fill in the blanks and get going quickly. Running a business isn't an art. It is a process. It's a recipe. And you'll find experts in every aspect of your business that can reduce it to a series of steps and tasks that will get you to the next level. And as a cash flow engineer, you have access through this program to a number of experts that can fill in the blanks where you don't have expertise, such as in marketing or in sales or other areas of a business that you can call on to ensure that your client gets the very best advice that you can give them. Okay, so let's get started looking at the 786 business control method, or we're going to start with that first element, the 7 key numbers. There's a myth that says that you need to track lots of numbers to be successful. The business management is just very complicated. That simply isn't so. There are only 7 key numbers that we want to look at today. And these 7 key numbers are a convenient way to diagnose a company, from lead generation and sales conversion to operations and financial management. The main takeaway is that these 7 key numbers create an interaction that traces the cascade effect of managerial decisions. The following discussion details the derivation of the 7 key numbers. Let's start with the basics. Revenue is based on quantity times price. Price can be further explained by an average price per transaction. In the restaurant business, they think in terms of average price per ticket, or how much can I get you to spend each time you come to our place of business. But you can't charge anybody anything until you first get a customer. So sales are a function of the number of leads you generate times a conversion rate. That gives us the number of new customers that we need. Then we look at the customer journey, or how we move them through our funnel from one purchase to another to generate a frequency of purchase. Milk may be purchased once a week, whereas a home is purchased once every 5 years or so. And we want to generate repeat business from each customer. This chart shows the process. From number of leads times conversion rate equals the number of new customers. We add the new customers we get to the customers that we've capped, which is our retention rate, equals our total number of customers, times the number of transactions we get, times the average sale, and that's how we calculate revenue. Once we've generated revenue, it's our obligation to control costs. But don't think like an accountant. Costs are all cash outflows. Variable costs, fixed costs, and other obligations such as debt payments and asset purchases. Expanding from above, we can generate the following chart. Can you see how this is transformational? Your accounting information may not present this in a clear fashion. So when budgeting, I use a totally different format to determine the achievability and reality of the budgeted numbers. I want to know how companies generate their revenue in order to determine their return on investment in various functions of their organization. Specifically, I relate their budget to marketing and sales, operations, and financial management, those 3 areas of business that we mentioned earlier. Here on your screen, the left side represents the marketing component of a company, and the right side represents the production, delivery, and fulfillment side of a business. The key to generating long-term success is to generate positive cash flow throughout the entire cycle at all times. This little illustration will help you explain to a business owner how money comes in and goes out of their business. Money or credit comes in from various sources, such as sales from products and services, loans, owner contributions, and interest income, among others. The flow of cash, or the water in this illustration, makes its way into a general trough. Then, money goes out to support operations and expenses. Until the money starts coming in faster than it's going out, and you create a water line that's high enough, there's no cash available for business owners to pay themselves. You must monitor your cash at every point, because the only time that you can really take money out of your business without killing it is when money is coming in faster than it's going out. Now here's the disconnect between accountants and business owners. Business owners think in terms of cash flowing into their business and going out. However, accountants look at everything to the left of the dotted line as income statement. This includes some of the money coming in and some of the money going out. On the right side is the balance sheet. Again, it reflects some but not all of the money coming in and going out. Cash flow and profits are not the same thing. Notice that I started with a profit goal in these illustrations. This is extremely important, and it's related to the key distinction between Wall Street and Main Street. Most small businesses work by the traditional formula: revenue minus cost equals profit. That means they make money and they spend money and they either owe or pocket the difference. This is reactive and doesn't let you control the business. But the big companies work off a different equation. Revenue minus profit equals cost. Expenses are the leftovers, not the profits. Do you see the difference? Wall Street reverses the formula. This says that whatever is left after you make money can be allocated to run the business. They start with a profit goal and make the adjustments necessary in their budget to achieve it. Very proactive. Again, there's a difference here. Wall Street teaches us to pay ourselves first, not last. So if we take a lesson from corporate America, this is how they survive in bad economies and thrive in good times. And there's a lesson in the language here that makes all the difference. Budgeting is just a formal way of saying that you structure every business activity based on what you intend to make, not on what you hope to make. This is the difference between Wall Street and Main Street. And we need to look at that lesson and help our clients apply it in their businesses. It's not just numbers. Nobody wants to go through their financial statements every day, which is why the 7 key numbers are so powerful. They're like headlines for your business. You glance at them every morning to know what's going to impact you that day. So let's look at these 7 numbers. You only need 7 numbers to manage an entire business, and we're going to illustrate how this is so. The first of these numbers is the number of leads coming into the funnel or into the business. Since all income comes from customers, you need a consistent, healthy stream of new prospects entering your pipeline. The number of leads measures this stream and will tell you how effective the marketing program is. The better a company is at getting new leads, the faster that business will grow and the healthier it will be. The second number we watch is the sales conversion rate, the number of leads that actually become customers. This number will tell you how effective your sales process is. This is a critical part of your income stream. Since most business owners love to do what they started the business to do, but they hate to sell, this is a number that tends to get overlooked. Don't let them make that mistake. Too many businesses are great at marketing and poor at sales. But remember this, no sales, no money. The third number is the customer retention rate. In other words, how many current customers will continue to come back and do business with you after the first transaction. The more customers you keep, the fewer new customers you need to get. That could lower your cost per transaction. And when you form a relationship with a customer, do you think of them as a customer for life? Or do you think of them as a more short-term relationship? Even high-ticket buyers like home buyers should be looked at as long-term repeat buyers. After all, you want your business to be around for a long, long time. That's what our clients want too. So help them look at their clients as long-term investments that will continue to pay over multiple transactions. Which brings us to number 4. Number 4 is the number of transactions per customer, and this measures how many times during a given period of time a customer will come back and do business with the company, or the average number of transactions that we get per customer. Again, too often we think in terms of one big transaction or one and done. Think of your local auto dealership, though. The automobile dealership sells a car for a large dollar amount, but then they offer service and parts that keep those customers coming back into the business on a regular basis. In fact, that dealership makes more money on the subsequent transactions than they do on the sale of the vehicle. Home buyers purchase a home, but then often there's remodeling, there's additions, there's even routine maintenance that can be added to a builder's bottom line if they just look at that customer and what their continuing needs might be. Number 5 measures the average price or ticket per transaction. In any given visit, how much will each customer spend on your goods or services? If you measure that, you can begin to answer the next question, well, what can I do to make that number larger? Is it by raising prices? Or bundling more goods and services every time we work with that customer? Look at the numbers so far. Numbers 3 through 5 tell you the lifetime value of a customer. And if you're not totally in tune with that, then you're not really thinking long term. Measure and manage your lifetime customer value, and you'll see your business steadily grow. Numbers 6 and 7 are ones that, as financial professionals, we're likely much more familiar with. And they measure how effective a business is at providing the services that it provides. Number 6 is your variable costs. While the first 5 numbers address money that comes into your business, number 6 measures how effectively a business uses its resources in purchasing, producing, and fulfilling a customer's purchase. Failing to monitor this number can sink a business fast. What we're going to do here and what you're going to be able to provide, though, fortunately for your clients, are some business-saving ways to control variable costs that will work with any business. And we're going to share those with you as part of this program. Number 7, then, is a critical number. It's fixed costs, your general business overhead and expenses. Finding the right balance between location and rent or mortgage, for example, can be tough. Do you base decisions on past business or potential business? How do you know when it's time to increase your investment or to cut back on overhead? Those are important questions. And again, as a certified cash flow engineer, you're going to have access to formulas that you'll have as part of this program that you can use to help your clients get and keep control of their overhead and expenses and help them make the right decisions at the right time, time after time. Before we go on, I want you to stop and let's do an exercise. Go to pages 21 and 22 in your Business Checkup workbook and start writing down your 7 key numbers. Take a few minutes and write down what those numbers, the results of those numbers for your business, and then we'll continue.